let's talk about rates from here in the U.S. to around the world. Arthur Dong joins us, teaching professor at Georgetown University's Business School. Good to see you as always. Let's start here in the U.S. You saw what happened yesterday. Your thoughts on whether or not this is, I guess, the end of the interest rate hiking cycle, as many experts say it is.
Yeah, thanks, Phil, for having me on. Yes, what was recently announced this week by Chairman Powell of the Federal Reserve was that the United States would raise their interest rates by 25 basis points. And so we see quickly two different views of what's going on here with interest rates. Wall Street and the financial markets reacted very favorably. And that what they saw was that, we went from 4 75 basis point increases in 2022. And then in December, a 50 basis point increase, and now a 25 basis point increase, would suggest that there's a tapering, that's happening with regard to the Fed's decisions to continue raising interest rates. Now, financial markets are thinking that the Fed has it wrong, and that inflation is actually coming, sort of reducing faster than the Fed acknowledges. And so what Wall Street is figuring right now is that the rate hikes are going to come to an end sooner rather than later.
There's a whole other argument.
Certainly not given any indication that the continuation of interest rate increases is going to taper anytime soon.
Right, but there's also another argument that these rate increases, again, specifically in the U.S., aren't working, because if you look at the long-term bond rates, the 5 and 10 and so on, they actually have gone down in the face of the central bank trying to raise rates. So yes, the short-term rates are high, but everything else that's tied to like long-term investments, homes, et cetera, has all gone the opposite direction. And I just wonder if you even think that this is the correct way to tackle inflation.
Yes, well, the thing is, markets are signaling that they believe that the recession is going to be a soft landing. And so there's a clear sentiment in the financial markets that they believe that whatever recessionary pressures that the United States is facing, the landing is going to be a smooth and a soft one, and therefore the Fed may be overshooting in terms of its rate hike decisions.
Right, and then you have our friends across the pond, both the ECB and the UK that we just spoke about. They're now, it seems like they're like 6 months behind what the US already did. So they're now tackling their inflation, they're raising rates. Finally, I suppose you could use the word catch up, but I wonder if it's going to have the intended effect that they're trying to have, which is to slow their economy down like we are, to also fight the inflation. But I just wonder if that's the right recipe. If it hasn't really worked all that well here, is it going to work over there?
Well, I think in the EU, they've been confronted with a set of circumstances that are much more severe than the United States in terms of the energy shocks. And they've demonstrated a remarkable amount of resiliency, going through the Russian war and recovering from their energy shocks. And so therefore, even within the ECB, they're saying and suggesting that they've got this inflation picture a bit under control, and they think it's manageable. And so therefore, yes, they've been moving in lockstep with a 50 basis point increase, in lockstep with the United States in a sense. But there are signals emanating from the ECB as well as the Bank of England that they believe that they have things under control, and that 2023 is going to be a manageable year, and they're going to return back to growth by 2024.
So there's a group that believes that the Fed and other central banks may very well overshoot and ultimately have to cut rates, right? In other words, a harder landing or a more severe recession. That's essentially what they're saying, is that they believe they have to cut rates to stimulate the economy, while at the same time, the IMF and other organizations are saying that we're going to have actually pretty decent growth coming up this year, partially because of what I guess fiscal policymakers are doing, but also because China's opening up once again, and we're going to see this global growth. They can't both be right at the same time, can they?
Well, both of the central banks in Europe and the Federal Reserve, the risk here is if you overshoot and you miscalculate, and a lot of people are going to wind up unemployed, and perhaps unnecessarily so. And so that's the risk that you're balancing. You're balancing higher unemployment against, trying to abate inflation. And so if you overshoot, the consequence and the unintended consequence may be higher levels of unemployment, which then will really create a challenge economically for these member nations.
I guess I bring that up because I want to speak on behalf of the investors that somebody is going to have a really bad day because they both can't be right. Either we end up in a harder landing or a more serious recession and everybody's a loser, or everything's fine and we shouldn't be talking about this and the world's looking just fantastic and we're at like super growth. But if that's the case, rates would then of course go up.
Well, you're seeing a clear divide between the Federal Reserve and financial markets, and the financial markets, seem to indicate that they have a higher degree of confidence that the United States and the rest of the world is going to come out of this in a much better shape, and perhaps that the Fed should recalculate and rethink their policy with regard to continued interest rate hikes.
I hope the La La Land scenario plays out for everybody's sake, and I do appreciate you trying to help us better understand the situation that we're in when it comes to rates. Good to see you, Professor. Thank you.
Thank you, Phil.